We were discussing the approaches. There are three approaches. As I said, income approach, which simply means that here the valuation is based on the income that is generated from the asset. Then a market approach would simply mean where the basis for the purpose of valuation is going to be the market information about that asset, and that is your market approach. And thirdly, as we were discussing, cost or the asset approach. And as I mentioned earlier, please remember many times when you would be reading about when you would be preparing for your exam and trying to read, you would come across this term asset approach or cost approach. Sometimes they would write asset approach, sometimes they would write cost approach. Now please remember, both mean the same thing. So that is how it is. So all these three approaches, friends, please remember, are universally applicable for all kinds of assets, without any difference whatsoever. So under the income approach, you will have two methods primarily: income capitalization or the discounted cash flow method. Income capitalization would simply mean that it is also known as PECV method, that is profit earning capability valuation. So profit earning capability valuation, so you call it profit earning capability valuation, or you call it income capitalization method. Both are same, and it simply mean that you try to find value of a company based on its past earning, and based on the past earning you try and estimate as to what is the capability of this business to earn profit in the times to come. So that is your income capitalization method, or PECV, profit earning capability valuation. Then you got a discounted cash flow. I am sure all of you must have heard of 10,000 times, but this in my view is the most important method for the purpose of valuation, that is discounted cash flow. And what is discounted cash flow? You try and project the future earnings of a company and discount it with the cost of capital of the company, and by discounting the future earnings of the future cash flow of the company by the appropriate cost of capital, you try and find out the present value of the future cash flows. The total of the present value of all these future cash flows put together is also known as intrinsic value, and it is also value of that asset or of that company. So that's your discounted cash flow. Under the market approach, you have again two methods. So you got a comparable company method, or you got a comparable transaction method. I'm sure no rocket science, as the name suggests, that itself will give you an idea as to how the valuation would be done in case of these two methods. So comparable company method would mean that you try to find out value of a company based on the value of a similar company about which information is available in the public domain. So that is your comparable company method, or comparable transaction method. So in case of comparable transaction method, the only difference is in case of a comparable company, you try and find value of a company based on the value of another company. In case of a comparable transaction, you try and find value of a transaction based on a similar transaction that may have taken place in any other by any other party. Just to give you a very simple example, you want to purchase, you go to a new city and you want to buy a house for yourself, right? So and you come across an offer where someone is offering you a house that you want to purchase. Now he's quoting you one price. So what you would do, you would try and find out कि इस एरिया में इस तरह का कोई घर किसी और ने बेचा या खरीदा है, आपकी जान पहचान वाला, और उसने अगर बेचा या खरीदा है तो उसने इसी तरह का घर कितने अमाउंट्स में परचेज या सेल किया है. So that becomes the basis for the purpose for you to arrive at appropriate valuation, and that is your comparable transaction method. Then you got a third approach, which is asset and cost approach. So under that you got a book value method. It is very simple. The value arrived based on the balance sheet of a company is book value. तो बैलेंस शीट में जो भी एसेट्स हैं उनकी जो भी अमाउंट्स दिए हुए हैं, जो भी लाइबिलिटीज़ हैं उनके जो भी अमाउंट्स दिए हुए हैं, बेस्ड ऑन दैट यू फिगर आउट द वैल्यू ऑफ दैट कंपनी. दैट इज बुक वैल्यू मेथड. Then you got a adjusted book value method. How it is different from the previous one? Very simple. Adjusted book value method would simply mean that you don't take the value as given in the balance sheet. You make appropriate adjustment to those values and then arrive at the value of the company. Say for example, you pick up a balance sheet of XYZ Limited. XYZ Limited has a land as an asset appearing in the balance sheet at a value of, let's say, 5 crore. Now this land was purchased by XYZ 20 years back at 5 crore. Today if you go and purchase this land in the market, or you sell this land in the market, it will fetch you 50 crores. So what you will do, adjusted book value, when you are trying to find out the value of a company based on the adjusted book value, you will not take this land at 5 crore, you will take this land at 50 crore. Why? Because that is the adjusted value of that land, and this is what you will do for all the assets which are appearing in the balance sheet of that company, and also all the liabilities which are appearing in the balance sheet of that company. And based on these two adjusted figures, you will arrive at the value. So that is your adjusted book value method. Then you got a replacement method, and replacement method would mean as is what is. So replacement means you want to find out value of an asset कि अगर ये जो asset है इसको ऐसा कि ऐसा replace करने जाएं, जैसा आज है वैसा कि वैसा replace करने जाएं, तो वो कितना amount होगा. That's your replacement method. And liquidation value method कि अगर ये कंपनी बंद होती है और सारी assets अगर इनको सेल करना पड़े तो सेल करके कितना पैसा आएगा, और वो जो पैसा आएगा उसमें से अगर हम जो लाइबिलिटीज़ है वो माइनस करेंगे और जो ये लिक्विडेशन करने के लिए जो खर्चा आएगा उसको माइनस करेंगे, वो सब माइनस करने के बाद जो अमाउंट हमारे हाथ में बचती है, दैट इज़ योर liquidation value. So friends, these are your three approaches and different methods. As far as the approaches are concerned, please remember there are only three approaches as I have explained to you. But as far as the methods are concerned, under the income, the two methods that I have explained to you would hold water, and these are the only two methods under the income approach. Under the market approach, you may have various permutations, combinations, and under the cost approach also you will have various permutations and combinations. But the broad framework would remain as we have discussed. Now, what is the relevance of fixed income securities? So I'm sure a question must have crossed in your mind when you must have registered for this program, and when you would have gone through the course curriculum, and when you would have come across this line, fixed income securities, valuation of fixed income securities. So a question may have come to your mind as to what is so great about fixed income securities that there is a separate module as part of the course curriculum. And let me tell you friends, the significance of fixed income securities. It appears to be very small in size, but it is not so. Now globally friends, the global bond market has more than quadrupled in size in last 15 years and now exceeds $150 trillion. So please remember, fixed income securities that we are discussing are also referred as bonds, and the bond market globally currently is of the size of $150 trillion, and that is the significance of valuation of fixed income securities. Against this, as per the S&P Dow Jones indices, the global stock market today is worth about $100 trillion. So you can imagine that the bond market or the market for the fixed income securities is 1.5 times bigger than the stock market, and that is the significance of the fixed income securities, and that is the reason as to why do we need to have good understanding of valuation of fixed income securities. अब देखिए फिर से एक बार आपको याद दिला दूं कि ultimately हम valuation क्यों जरूरी है. Valuation is necessary because decisions are to be taken, and if decisions are to be taken, then how do we take those decisions? So for taking the decisions, so what kind of decisions do we take? We take decisions of buying an asset or selling an asset, isn't it? So whether it is buying an asset or selling an asset, the asset can be anything. The asset can be a plant and machinery, asset can be a company, asset can be a derivative, asset can be a land and building, asset can be a derivative product, asset can be intangible asset, asset can be tangible asset, or asset can be a bond. In all the cases, whenever we have to take a decision for buying an asset or selling an asset, ultimately we will need to fix a price. And for fixing that price, we need to have good understanding of valuation. And that is also applicable, as I said earlier, in case of fixed income securities as well. And that is the significance, friends, of fixed income securities. So please remember, the bond market is one and a half times bigger in size than the stock market globally. Now, what kind of decisions, what is the role of valuation in fixed income securities? So the role of valuation in fixed income securities, number one, is valuation of different financial assets and liabilities are to be done, right? Number two, we have to take decision for buying or selling or holding by the market players. Number three, investment planning and portfolio management. So I have invested in a bond, I've invested in a government of India security, I've invested into the corporate bonds, I've invested into the in debentures, I've invested into some other fixed income securities. So as a wealth manager, as investment manager, as provident fund, as pension fund, as gratuity fund, as mutual fund, as private equity fund, as venture capital fund. Now, as the manager of all these kind of funds, I will have to take decisions from time to time कि मैं ये इसको होल्ड करूं, कि इसको सेल करूं, कि जो नया जो इश्यू आ रहा है उसको बाय करूं तो कैसे, हाउ डू आई टेक अ डिसीजन वेदर आई मस्ट इन्वेस्ट इनटू अ नेक्स्ट न्यू इश्यू और नॉट. That I can do only if I have a good understanding of fixed income securities. And who are the players in case of fixed income securities, or in case of bond market, or in case of debentures or the such securities? So you have people who need this information of valuation of fixed income securities. Who are these people? These people are portfolio manager, investment funds, treasury department of corporates. And I'm sure you can understand corporates of all the companies all over the world, they have treasury departments, and the job of the treasury departments of all the corporates across the globe is to ensure the proper deployment of funds, surplus funds that may be available with those corporates, maybe for short term, medium term, or for long term. So the treasury departments of the corporates would need to have good understanding of valuation of fixed income securities. Banks and financial institutions, we of course understand that banks and financial institutions deal so extensively in the fixed income securities. Insurance companies, pension funds, mutual funds, ventures, and equity funds. So these are the people who need to have a very good understanding of fixed income securities. So remember, we may not be working with these companies or these entities, but as independent professional valuer or valuation professional, we may be required to advise them as to what kind of valuations should be ascribed to a particular security to all these companies. Now, let's understand, friends, as to which are the key terms as far as the valuation of fixed income securities are concerned. So number one is the face value. We all understand. So every instrument of every fixed income security has a face value, and we all understand what the face value is. Then the second term that we need to understand is coupon, which is same as interest. So the fixed income securities invariably will be interest bearing, right? Fixed income securities invariably will be interest bearing. So when I say invariably, what does it mean? It means at times the fixed income securities can also be a zero coupon bond, right? So that means such securities will not carry any fixed coupon rate, but they will be issued at a discount. So you have a coupon rate or interest rate. Issue price. So every fixed income security, when it is issued, it is issued at a price, and that price, please remember, can be different from the face value. And why do I say this? Say for example, a zero coupon bond has got a face value of 1000 rupees, but since it is a zero coupon bond, or it is also known as discount bond, it would be issued at a discount. So the face value will be 1000 rupees and the issue price can be maybe 500, 400, 300, 200 depending on the tenure of that bond. So that's your issue price. Then you have coupon frequency. So what is coupon frequency? Coupon frequency would mean the frequency at which interest is to be paid on these fixed income securities. And remember, technically and principally and theoretically, interest can be paid on a security on monthly rests, on quarterly rests, on half yearly rests, or on the annual. So this is how the interest payment will happen. So frequency of the coupon or the interest. Then every fixed income security will have a maturity or will have a tenure. So maturity means fixed income security can be issued for 5 years, 7 years, 10 years, 20 years, 30 years, 40 years, and sometimes they can also be issued for perpetuity. That means there is no defined tenure for the perpetuity bond. I'm sure you all must have heard of it many times. Then you got a nominal yield. So what is nominal yield? Nominal yield is nothing but the rate of interest of a particular fixed income security. Against the nominal yield, you will have current yield. So how would you differentiate between the nominal yield and the current yield? Remember, nominal yield is the rate of return on the face value of that fixed income security. So that is your nominal yield. Current yield would mean the return divided by the current market price of that security. And please remember, these securities at times can trade in the market at a discount or they can trade in the market at a premium. Depending on the interest scenario, it can happen. So let's say if on a bond, or on a 10% bond, of 100 rupees, the nominal yield is 10%. Nominal yield is 10%. But if this bond tomorrow is currently is traded at 90 rupees, then the yield is going to be 10 divided by 90. So that means the yield will be, current yield may be 11.11%. And that is what is your current yield. Then you got an indenture. Now what is indenture? It is nothing but every time when a fixed income security is being issued by any issuer, he will have to sign a contract. And that contract is known as indenture. So indenture is nothing but a contract issued by the issuer or signed between the subscriber and the issuer, and this indenture will have all the terms and conditions, rights and obligations of the issuer and the rights and obligations of the subscriber. Then it will have a redemption value. So a bond will have a redemption value, and please remember, many times these bonds are redeemed at a premium. Okay, so that is what redemption value. So redemption value can be same as the face value. Redemption value can also be at a premium. Invariably it will be at a premium, because if the redemption is at a discount, I'm not sure as to how many people would subscribe for it. Then you have something called as yield to maturity. Now this is something, friends, all of you need to really understand very clearly, and I'm going to spend a lot more extra time in understanding as to what is YTM, because YTM is extremely important when it comes to the valuation of fixed income securities. YTM is extremely important when it comes to taking decisions about investment or divestment in the bond market. So we will understand YTM very, very clearly, and I would like to make it in such a way so that there's a total clarity in your mind with regard to YTM. But at this point in time, I would just only like to help you a little bit and tell you, don't get confused when I say YTM with anything else. In simple words, YTM is nothing but IRR. I'm sure all of you would have learned IRR so many times in your career. So what is IRR? Internal rate of return. And what is YTM? Please remember, YTM is nothing but IRR only. The only difference is we use the term IRR in the context of valuation of capexes, organic or inorganic, but we do use the term IRR in the context of valuation of capexes, organic or inorganic. And the term YTM is also same as IRR. We use it in the context of valuation of fixed income securities. That is the only difference between the IRR and YTM. If you have understood this, I am sure your understanding of YTM will become very simple. And that is what it is. Then you have something called as dirty price, and then you got something called as clean price. We will understand it with the help of an example. And then we need to understand priority in payment, and which all of us know that a bond being a debt instrument, a fixed income security invariably being a debt instrument, will always have a priority in repayment by the issuer in case if the issuer goes in for liquidation, and that is in principle because debt has to be paid first. Now friends, all these fixed income securities, as I said, are also known as bond. And please understand why is that these fixed income securities are also referred as bond. And again, remember, no rocket science, it's very simple. So whenever someone is issuing fixed income securities, whether it is a corporate or it is a government or it is a semi-government organization or it may be anyone. So whenever someone is issuing fixed income securities, he is kind of signing a bond with the subscriber. And what this bond is the issuer is taking an obligation to service the debt that he is raising by issuing these bonds, to service this bond and pay interest to the subscriber, and also on the redemption date pay the money back to the subscriber. So he is signing a bond, and that is why, colloquially, these fixed income securities are also referred as bond, because there's a bond between the issuer and the subscriber, and that is the reason why fixed income securities are also referred as bond. And then of course, then it has become, over the years, it has become known as bond market. Now let's understand what are the different types of fixed income securities or different types of bonds. And please remember, so whenever I would say bond or I would say fixed income securities, in your mind you can read that I am referring to the same thing. So first is the types of bonds which are available. One is floating rate bonds, very simple. The rate of interest applicable on these bonds is linked with some other index. It can be MIBOR, it can be LIBOR, it can be anything else, right? So the rate of interest, rate of coupon, or it can be inflation linked also. So the rate of interest can be linked with the inflation of a particular economy. So that is when the rate of interest is not fixed, it is known as floating rate bond. When the rate of interest or rate of coupon is fixed, it is known as fixed rate bond. Then you can have zero coupon bond or deep discount bond. Please remember, you call them zero coupon bond or you call them deep discount bond. Both mean the same thing. So it means what? It means the subscriber will not have the benefit of receiving interest periodically. Instead of it, what will happen? At the time of redemption, he will get the face value of that bond, and whereas he would have paid a discounted price at the time of the issue. To give you an example, the bonds is the face value of the bond is 1,000 rupees, tenure is 5 years, and therefore 5 years. So therefore it is possible that this bond was issued at 600 rupees. So the subscriber has paid 600 rupees for this bond. For 5 years he will not get any interest. At the end of 5th year he will get 1,000 rupees. So his return becomes 400 on the investment of 600 that he has made initially, and that is how they are known as deep discount bond. Convertible bonds or non-convertible bonds. So what is convertible bond? What is non-convertible bonds? It's same as like convertible debenture or convertible preference shares. So a convertible bond is one which eventually gets converted into equity shares of that company. Non-convertible are the ones which will not get converted into equity shares. They would remain as a bond, as a debt instrument only until the time they are redeemed by the issuer. So that's your convertible and the non-convertible. Callable and potable bonds. So remember, a bond can be a plain simple bond. A bond can also have a put option or the call option. So when is a bond potable and when a bond is callable. So let's understand what is a callable bond. Callable bond simply would mean that the issuer has a right to redeem this bond even before the maturity date. So he has the option to call and redeem the bond before the maturity, but of course it would always be after a certain period. So maybe issuer XYZ company is issuing debenture with a call option, and that call option is after the expiry of 1.5 year, XYZ will have the option to call the debentures and redeem the same to the subscriber. And I am sure you can understand the rate of interest in case of a callable bond will generally be higher than the normal bond. And why is that so? That is because with a call option, issuer is having an advantage and the subscriber is having a disadvantage. What is the advantage the issuer has? The advantage the issuer has is, in case if the interest rates in the market fall down, the issuer can redeem the bonds, the existing bonds, and reissue a fresh series of bond at a lower rate of interest. Thereby, the issuer will be able to reduce his cost, and this becomes a disadvantage to the subscriber because he had the advantage of receiving high rate of interest. Now, since this debenture, this bond is being redeemed, this advantage that he had has gone, and that is why whenever there's a callable bond, the rate of interest offered by the issuer is going to be a bit higher than the normal rate of interest offered on the normal bonds. Then you got a potable bond. So what is a potable bond? So in case of a callable bond, issuer has the option to redeem it prematurely. In case of a potable bond, the subscriber has the option to go for redemption of this bond. And why should that happen? Please understand. So XYZ has issued potable bond where the subscriber has the option to get the bonds redeemed before the maturity. And why should a subscriber, why should a holder of a bond would do that? And he would do it because since the issue of this bond, the interest rates in the market have gone up. That means the holder of the bond has an option to subscribe for new issues of bonds of other companies where he would be able to earn higher rate of interest, and that is why he would like to redeem it. And I'm sure you can understand. So in case of a bond with a put option, the rate of interest is going to be a bit lower than the rate of interest applicable on other bonds. Why? Because a putable bond gives an extra privilege or extra facility or extra advantage to the subscriber of the bond. So that is a callable and the putable bonds. Please remember, whenever a bond has a call option or put option, this bond is known as embedded security. This bond is known as embedded security. And why this bond is known as embedded security? Because now this bond has got an option embedded into it. That option may be call option, that option may be put option. In either case, it is an option which is embedded in the bond, and that is what is known as embedded security. A question that can come to your mind and should come to your mind: can a bond have both these features? Is it possible that a company is issuing a bond with call option and as well as the put option? And the answer, of course, is very simple. Yes, it is very much possible. A company can issue a bond with both the options. That means a company is issuing the bond, it has a call option, it has a put option. So depending on the changes in the market scenario, either the company can redeem the bond prematurely, or the subscriber can also go for the redemption of the bond prematurely, depending on as to how the market interest rates in the market have moved. Then you have a perpetual bond. So perpetual bond would simply mean that these bonds do not have a fixed maturity. So these do not have a fixed tenure. So normally a bond will have a tenure of 5 years, 7 years, 10 years, 20 years, 30 years, 40 years, even 100 years. But these perpetuity bonds do not have any fixed tenure, so they are issued for perpetuity. Yes, of course, the subscriber will invariably these perpetual bonds will have the put option, will have the call option uh, uh, built into these perpetual bonds, so that at any point in time, if subscriber wants to get out of them, he can do so, or if the issuer wants to get out of them, he also can do so. But there is no fixed maturity or tenure. Tax-free bonds, of course, these are the bonds which are issued by the government, owned organizations, and that's where the objective is to offer incentive to the subscriber. So generally, infrastructure bonds which are issued by the different government bodies will be tax-free bonds, because infrastructure projects do not give returns very fast. So just to entice or motivate them, they come out with the tax-free bonds. So tax-free bonds will give benefit to the subscriber, that to the extent of the investment that he makes as per the prescribed thresholds by the government, he will get the benefit of tax exemption. Junk bonds are the bonds which are risky in nature, but they offer very high rate of return. Income bonds, remember, though the income bonds would give you an impression that these are the bonds on which income is paid by the issuer. No, income bonds on the contrary are the bonds which will pay interest only if that bond is generating income, or that issuer is generating income, and not otherwise. Subordinated bonds, that means these are the bonds which are subordinated to, they are semi-secured bonds, right? So when a company has issued bonds which are fully secured, then the company is coming out with second series of the bonds which are also secured, but subject to the security of the first series of the bond, and that is known as subordinated bonds. Bearer bonds, so normally a bond will be owned by a specific person, and that specific person only will be entitled to the benefits accruing on that particular bond. But a bond can also be a bearer bond. That means what? That means these bonds are easily transferable. These bonds are transferable simply by handing over. So whoever has those bonds, he becomes the owner of those bonds. Yankee bonds, very simple. When a foreign company issues bonds in another company, right? Those bonds are issued as a Yankee bond. So if Indian company goes and raises money in America by issuing bonds in American market, now these bonds are known as Yankee bonds. It has got nothing to do with China. So remember, it's just when a company outside the country raising money in the country, such bonds are referred as Yankee bonds. Inflation linked bonds, as I said earlier, remember, inflation linked bonds simply would mean that the rate of interest on these bonds is linked with the rate of inflation. So these are, you can also understand, would also be falling into the category of floating rate bonds. Then you got asset backed securities, and that is where you have the securitization of the assets. So all these home loan companies or these credit card companies, what they would do, or the personal loan companies. Now what these companies would do to raise more capital, they will securitize securitize the receivables that they have from the borrowers, and use these securitized receivable for raising more capital. And for raising more capital, what they issue is known as asset backed security. So friends, these are the different types of fixed income securities or bonds which are available or raised in the global bond market. But remember, is just an indication. It's not an exhaustive list. So one can keep on exploring and keep on finding out many other different kinds of bonds. But broadly, these are the types of bonds which are there in the domain of fixed income securities. Now, before we move forward, I can leave it open for all of you. and we can take few questions.